Well, good morning and welcome everyone. This is an open meeting of the Public Company Accounting Oversight Board on August 13, 2013. And we want to welcome all of you who have joined us today in person or by listening to the webcast of this meeting. Today, the board will consider a recommendation to propose auditing standards on potential changes to the auditor's reporting model. Before we proceed with the agenda, though, I want to note for the record that all board members are present. The first and only order of business before the board today is a staff recommendation that the board propose auditing standards on the auditor's reporting model. To present the staff's recommendation for this agenda item, I will turn to our Chief Auditor's Office for the staff's presentation and to our Chief Auditor, Mr. Baumann.
Good morning, Mr. Chairman and members of the board. We are here today to propose two new auditing standards and related amendments intended to make significant improvements to the existing auditor's reporting model. Joining me here to make these proposals and respond to your questions are Jennifer Rand and Jessica Watts, senior members of my staff, and Andres Vanelli, the PCAOB's chief economist. The standards being proposed today are the auditor's report on an audit of financial statements when the auditor expresses an unqualified opinion, and secondly, the auditor's responsibilities regarding other information in certain documents containing audited financial statements and the related auditor's report. The audit report, as it exists today, identifies the financial statements audited, briefly describes the nature of an audit in very general terms, and presents the auditor's opinion as to whether the financial statements are presented fairly. This type of report is commonly called the pass-fail model. In fact, many investors say the only reason they look at the auditor's report at all is to be certain that the opinion is unqualified, the passing grade, and not modified in any way, a failing grade. Generally, there is nothing else in an audit report that is specific to a particular audit. The audit report has not changed in any substantive way since the 1940s, despite numerous studies indicating the auditor's report does not meet the needs of investors. To address this need for changes in the auditor's report, over the past several years, the PCAOB has conducted extensive outreach, issued a concept release, and hosted a roundtable to hear from all interested constituencies. In addition, the board's investor advisory group and its standing advisory group have both devoted substantial effort to addressing possible changes in the auditor's reporting model. Through today's proposed standards that we are asking the board to issue for public comment, I believe we are substantially improving the auditor's report in ways that will make it much more relevant and useful for investors and other users of the financial statements. Highlights of our proposal include the following. First, disclosure in the audit report of critical audit matters specific to each audit. Second, providing in the audit report more information about the audit and the auditor, including requirements regarding auditor independence and information about the length of the auditor-company relationship. And third, describing in the audit report, 1, the auditor's responsibility to read and evaluate other information in the annual report outside of the financial statements, and 2, the results of the auditor's evaluation of that other information. The audit report would continue to require a clear expression of the auditor's opinion on the financial statements as well. In other words, continuing the pass-fail model. Investors have said that a clear expression of that opinion is valuable. Also, the audit report will be clear that the discussion of critical audit matters in the audit report does not alter in any way the auditor's opinion on the financial statements. Critical audit matters, as the name implies, are about the audit. These are matters that posed the most difficulty to the auditor in performing the audit. The auditor would be required to identify these matters in the audit report, and in the audit report also describe the considerations that led the auditor to determine the matters or critical audit matters, and then refer to relevant financial statement accounts and disclosures. By communicating critical audit matters, the auditor would be providing investors and others with previously unknown information about the audit. This could enable investors and others to analyze more closely and carefully the related financial statements, accounts, and disclosures. Critical audit matters are determined based on the results of the auditor's work in forming an opinion. They are at the heart of what the auditor does. Various other alternatives were considered by us in the process of developing the proposed standards. Some in our outreach suggested that improvements to the auditor's report should require the auditor to provide commentary on the financial statements or to point out matters in the financial statements that are of greatest significance. The staff is not proposing these approaches for a number of reasons. For example, we believe such approaches would be very costly to implement, could result in delays in financial reporting, would fundamentally change the auditor's role from an attest role to that of a financial analyst, and could interfere with the role of the audit committee. As I said earlier, critical audit matters provide valuable information about the audit of the financial statements. The staff believes that this approach provides many of the benefits of the other alternatives considered, but should eliminate or reduce many of the challenges presented by these other alternatives. At the same time, our proposed approach is very cost-sensitive because the reporting is tied to the fundamental underlying work performed by the auditor as part of the audit. Much work went into these proposals by many individuals within the PCAOB, and we appreciate the great support we received throughout the organization. I would like to particularly express my appreciation to those in the Office of the Chief Auditor who worked tirelessly in developing these proposals. They are Jennifer Rand, Jessica Watts, Lillian Sanoa, Elena Boshkova, Ekaterina Disna, Karen Burgess, and John Powers. We also could not have completed this work without the help of the PCAOB's economists in the Office of Research and Analysis, including Andres Vanelli and Morris Mittler, and attorneys in the Office of General Counsel, including Bob Burns and Jennifer Williams. Finally, I would like to express my appreciation to the staff of the Securities and Exchange Commission, who provided us with invaluable advice and support. Let's now hear from Jennifer Rand and Jessica Watts.
Thank you, Marty. I plan to talk more about critical audit matters, which as Marty said, is really at the heart, a significant change of this proposal. The information to be communicated in critical audit matters would be based on information known to the auditor and procedures that the auditor has already performed as part of the audit. As defined in the proposed standard, critical audit matters are those matters addressed during the audit that, 1, involve the most difficult, subjective, or complex auditor judgments, 2, pose the most difficulty to the auditor in obtaining sufficient appropriate evidence, or 3, pose the most difficulty to the auditor in forming an opinion on the financial statements. The use of the word most in the definition does not imply that only one matter under each criteria would qualify as a critical audit matter. Depending on the facts and circumstances of the audit, there could be several critical audit matters, and it is our expectation that for most audits, there would be several audit matters that would meet the definition of a critical audit matter. The auditor would determine which matters to communicate as critical audit matters based on the results of the audit and the audit evidence obtained. The proposed auditor reporting standard indicates that critical audit matters are ordinarily of such importance that they are included in matters to be documented in the engagement completion document, which is a document that summarizes the significant issues and findings in the audit. They would also be reviewed by the engagement quality reviewer, also communicated to the audit committee, or any combination of those three. It is not expected that each matter included in any one or more of these sources would be a critical audit matter. Rather, referring to these sources can provide a cost-effective and efficient means for the auditor of determining critical audit matters. The proposed standard also provides a list of factors to the auditor for the auditor to take into account in determining the critical audit matters. The factors are intended to help the auditor determine from the results of the audit or audit evidence obtained which matters are critical audit matters. The proposed auditor reporting standard would require the auditor to communicate critical audit matters for the audit of the current period's financial statements. This approach would provide relevant information about the most recent audit. It is intended to reflect a cost-sensitive approach to auditor reporting. In addition, investors and other financial statement users would be able to look at prior year's filings to analyze critical audit matters over time. The proposed standard provides that in situations when, 1, the prior period's financial statements are made public for the first time, such as at an IPO, or 2, when issuing an auditor's report on the prior period's financial statements, because the previously issued auditor's report could no longer be relied upon, that in those situations the auditor should consider communicating critical audit matters relating to prior periods. In the report, the description of critical audit matters would include the following. First, identify the critical audit matter, or each critical audit matter that the auditor determined to communicate. 2, describe the considerations that led the auditor to determine that the matter is a critical audit matter. What were those reasons that the matter caused the most difficulty to the auditor in forming the opinion, had significant judgment, or difficulty obtaining evidence, those type of considerations. And then finally, 3, refer to the relevant financial statement accounts and disclosures that relate to the critical audit matter when applicable. In communicating critical audit matters in the auditor's report, it is expected that the communication would be presented in language and in a format that is clear, concise, and understandable to a financial statement user, is tailored to the audit, that it avoids boilerplate language, and that it reflects the specific circumstances of the matter in relation to the audit of the company's financial statements. And as Marty said, the communication should not alter in any way the auditor's opinion on the financial statements taken as a whole. In situations in which the auditor determines there are no critical audit matters to communicate, the auditor would state that conclusion in the auditor's report. To assist commoners in understanding the types of communication expected in the auditor's report, the proposal includes 3 illustrative hypothetical examples of critical audit matters in the auditor's report. Documentation. The proposed auditor reporting standard would also require a documentation requirement, specifically for each reported matter that was a required audit matter, and also for non-reported audit matters that would appear to meet the definition of a critical audit matter, but were not reported as such in the auditor's report. This documentation requirement is intended to help the auditor and other reviewers, such as the engagement quality reviewer, have a better understanding of the basis for the auditor's determination. In fulfilling this documentation requirement, the auditor would not be expected to provide an explanation for each matter that was documented in the engagement completion document, reviewed by the engagement quality reviewer, or reviewed by the audit committee, communicated to the audit committee. The auditor would only be expected to document those things that were either communicated as critical audit matters or that would otherwise appear to meet the definition of a critical audit matter. In summary, it is our hope that communicating critical audit matters would provide meaningful information to investors and other financial statement users about the auditor's work in performing the audit and informing the opinion on the financial statements taken as a whole. Let me now turn it over to Jessica Watts, who will describe the other 2 areas of major change in the project.
Thanks, Jennifer. The other 2 areas of major change to the auditor's report include 1, providing more information about the audit and the auditor, and 2, describing the auditor's responsibilities to evaluate other information outside the financial statements and the results of that evaluation. Related to more information about the audit and the auditor, the proposed auditor's report would further describe some of the auditor's existing responsibilities, such as the auditor's responsibilities for the notes to the financial statements and the risks of material misstatement due to fraud, and adds new elements to provide investors and other financial statement users with information about the auditor. These elements are Auditor Independence and Auditor Tenure. For independence, the proposed standards would require the auditor to include a statement in the auditor's report that the auditor is a public accounting firm registered with the PCAOB and is required to be independent with respect to the company in accordance with the United States federal securities laws and the applicable rules and regulations of the SEC and the PCAOB. Under PCAOB and SEC rules, the auditor is required to be independent of the company. This statement in the auditor's report is intended to enhance investors' understanding about the auditor's obligations related to independence and to serve as a reminder to the auditor of these obligations. Related to tenure, the auditor would be required to include in the auditor's report a statement containing the year the auditor began serving as the company's auditor. Currently, this information is not required to be communicated by the auditor, management, or the audit committee to investors. Auditor tenure has been a subject for discussion for decades, and investors and others have indicated strong interest in this information. In light of the public interest, we are proposing to include auditor tenure as a data point in the auditor's report. The intent of the proposed requirement is to disclose the duration of the auditor's relationship with the company. The other major proposed change would require the auditor to refer to the reporting requirements contained in the board's companion proposed standard, which is the auditor's responsibility regarding other information in certain documents containing audited financial statements and the related auditor's report. During the board's outreach process, some commenters indicated that they would support changes to the auditor's report that describe the auditor's responsibilities related to other information outside the financial statements and the conclusions. In order to provide a specific basis to better explain to investors the auditor's responsibilities related to other information, we determined that changes to the existing other information standard were appropriate. As a result of the link between the two proposed standards, the financial statement user would obtain useful information such as 1. The nature and scope of the auditor's responsibilities with respect to other information, 2. Clarification of what other information was evaluated, and 3. A description of the results of that evaluation. The proposed other information standard would strengthen the audit procedures the auditor would perform related to other information. The standard describes other information as information other than the audited financial statements and the related auditor's report in a company's annual report that is filed with the SEC under the Exchange Act and contains that company's audited financial statement and the related auditor's report. As described, the auditor's responsibilities with respect to other information would thus focus on other information contained in annual reports filed with the SEC, such as Form 10-K. Annual reports filed with the SEC contain other information that is relevant and of interest to investors. These changes are intended to make the auditor's report more informative. The proposed standard would require the auditor to evaluate whether the other information contains a material inconsistency, a material misstatement of fact, or both. This evaluation would be based on the relevant audit evidence obtained and conclusions reached during the audit, and would not require the auditor to obtain new evidence. In addition to reading the other information, the auditor's evaluation under the proposed other information standard would include performing procedures intended to help the auditor identify whether other information contains a material inconsistency or a material misstatement of fact. The procedures are to evaluate 1. The consistency of amounts in the other information with the amounts in the financial statements and relevant audit evidence. 2. The consistency of any qualitative statements and the other information that is intended to represent or provide greater detail about information in the financial statements. Evaluate other information not directly related to the financial statements compared to relevant audit evidence obtained and conclusions reached during the audit. And lastly, recalculate certain amounts for mathematical accuracy. The proposed other information standard provides specific responses when the auditor identifies a material inconsistency or material misstatement of fact, such as communication with management and further procedures as necessary. As noted previously, those procedures provide a basis for the auditor report in the auditor's report the auditor's responsibilities for and the results of the auditor's evaluation. Therefore, when issuing the auditor's report, the auditor would include in a separate section specific statements regarding the auditor's responsibilities for the other information. And regardless of whether the auditor identifies a material inconsistency, a material misstatement of fact, or both, the auditor would report the results of that evaluation. Reporting on the results of the auditor's evaluation of the other information would provide potentially significant information for investors. In closing, the release includes a number of questions for which we are seeking specific feedback. We would also encourage comments from interested parties on topics for which we have not posed specific questions. The staff recommends that the board issue the proposed auditing standards for a 120-day comment period ending December 11, 2013. We would be happy to answer any questions.
Thank you, Mr. Bowen, Ms. Rand, Ms. Watts. I want to join our Chief Auditor in acknowledging all the staff who helped bring this project to fruition. In particular, Karen Burgess, John Powers, Lillian Sonoya, Elena Boshkova, and Ekaterina Dishna in the Chief Auditor's Office. Bob Burns, Jennifer Williams from the General Counsel's Office, as well as Andres Vanelli and Morris Mittler in the Office of Research and Analysis. I'm also grateful, as is the Chief Auditor, to our colleagues at the SEC, Chief Accountant Paul Beswick and Deputy Chief Accountant Brian Croteau, and their team for their assistance in helping us commence this important project in a timely way in light of the global public policy debate that is going on as we speak. In that regard, I would like also to thank my fellow board members and their staff for significant contributions to make this proposal as useful and timely as it can be for public consideration. The last 3 weeks have been very intense for both staff of the PCAOB, staff of the United States Securities Exchange Commission, and board members and their staff. And so there are many people whose extra efforts brought us to this meeting. The proposed standards to enhance the audit reporting model mark a watershed moment, I believe, for auditing in the United States. To arrive at an opinion as to whether financial statements are fairly presented, the auditor amasses a great body of evidence, then distills that evidence into a collection of judgments which form the basis for the audit opinion. Investors rely on the opinion, and they necessarily depend on those underlying judgments. Yet the judgments themselves are merely implied, assumed to stand behind the opinion, out of reach to the typical investor. The standard form audit report was designed by the audit profession more than 70 years ago, and while it serves a critical purpose, as our presenters have said, many questions have arisen as to whether it still has value and whether it could do more. Other participants in the markets have been able to obtain for themselves or for their investors deep insights from the auditor, in addition to the backstop of a passing grade. Venture capitalists, private investors come to mind. Most investors in the public markets lack that kind of access, and broad popular participation has made our public markets strong and deep with liquidity. However, diversified ownership has weaknesses, including no direct access to the auditor's insights on the most significant matters the auditor addressed in the audit. The proposed standards before the board today would make the audit report more relevant, I think, to investors by establishing criteria and a framework providing deeper insights from the audit, based, as the Chief Auditor has said, on information the auditor already knows from the audit. The proposed standards are based on extensive outreach, public comment on both what would make the auditor's report more useful, as well as what auditors are in a position to deliver. I see the proposed standards as a first step. They've been a long time coming, more than 10 years after Enron and other financial reporting failures that led Congress to establish the PCAOB to devote close, independent oversight to the audit. Nearly 5 years after the first effects of the financial crisis that still looms over sectors of the U.S. and European economies. But now, having opened the audit report to address the needs of users, it will not, I think, be another 70 years before it is opened again. Changes may be incremental as we evaluate the usefulness of improvements and, if successful, engender further change as demand for more kinds of auditor assurance and involvement grows. Changes may be incremental, but change can do this. For now, by requiring and providing a framework to report critical audit matters, the proposed standards would keep the auditor in the area of expertise, the audit. No one wants to return to days before the pass-fail model was instituted, when free writing could obscure a disclaimer of assurance on financial statements. There's a real public interest in retaining the binary pass-fail model. The proposed framework provides concrete criteria and factors to consider and apply in light of the specific audit at issue, in order to limit both the discretion and to avoid the discretion to avoid disclosure and to avoid the opportunity to fall back on boilerplate. So we have got, we think, both criteria that limit the discretion to avoid disclosure as well as avoid boilerplate. Today's proposal would also require auditors to evaluate certain other information besides the financial statements, such as the company's annual report, management's discussion and analysis. For the first time, the audit report would describe this evaluation and its results. We retain management's responsibility for the financial information. The proposal stops far short of requiring a full audit of that information. Annual reports include a range of information and business metrics that the auditor does not audit. The auditor by no means knows everything about those metrics, but the auditor does learn a great deal about the company through its audit. Where that knowledge reveals, and I emphasize reveals, a discrepancy with this other information, the auditor should see that it's fixed or report it. And here too, today's proposal seeks to capitalize on auditor knowledge and ensure that the audit retains its value in the eyes of investors. These are, in my view, more than just promising ideas. I believe that today's proposal presents a coherent, intellectually rigorous, and disciplined analytical model designed to promote more useful reporting to the public. This proposal is suffused with economic scholarship. It is replete with economic research, and it breathes and exudes discipline and thought. That said, we all know any proposal can be improved, and I look forward to public comment that will help us shape the new audit report in the most useful ways practical. I want to turn now to my fellow board members for statements we wish to make. We will hold questions until the board members have had a chance to make a statement. And then, at Louis Ferguson's suggestion, I think we'll go seriatim through the board, each board member asking one question, then coming back and doing as many rounds as we need, and hopefully concluding before 3:30 this afternoon. But I think we'll get through it. With that, Board Member Ferguson.
Thank you, Mr. Chairman. I also want to say that I enthusiastically support these proposed standards, and I want to join Marty and Jim in congratulating you all on what has just been an extraordinary effort. It's an effort of more than 2 years, and I'm not going to go through and list all the names of people again, but let me tell you, I personally deeply appreciate what you've done. I deeply appreciate the work that the Office of General Counsel has done, that Andres, you and your colleagues at Aura, and as always, our SEC colleagues who give very useful and patient comments to us. So I support that. And I have had a lengthy statement here, which rather than boring you all with reading it, I have put it in the record, and I simply want to talk briefly about some of my own thoughts about this and what's led me to support this and support the particular approach that's been adopted here. You know, one of the things that was particularly important as we did these various outreach efforts here with various advisory groups and roundtables and comment proposals and things was to realize that many of the considerations that were being raised were directly competing. There were ideas and things that basically were quite contradictory and essentially had to be balanced. What I think is particularly useful about this proposal is that it represents a judicious and I think quite wise balance of a number of facts. First, it retains the binary historic nature of the audit report, whose great benefit was that it allowed comparability among audit reports. Two, it attempts to provide meaningful information, but information about those areas where the auditor truly has expertise, where the auditor has the greatest knowledge and where the auditor does his work, namely items about the audit itself. And third, it does this without usurping the primary role which is given in the U.S. federal securities laws to management in reporting on the company. And one of the main objections which I found quite persuasive against an auditor commentary was that if the auditor were simply free writing, essentially writing a book report or a review of the financial statements, that this would have the dangerous consequence of potentially usurping the role of management and could lead to dueling disclosures, which would be, frankly, intolerable from a market standpoint. The approach, I think, was based on two fundamental assumptions. One, that auditors are very skilled in certain things, but they're not necessarily skilled in the kinds of things that are the woof and warp of daily management, namely what the business prospects are, what the risks of the business are, what succession planning are, the kinds of things that really have to do with a lot of business risk. But that's not what auditors do. What auditors do is that they look at the audit. They look at how to verify, how to get to the position where they can say that the financial statements are fairly presented. And that's the area where I think the board came to the conclusion that the auditor can provide more information. The interesting approach that we've taken here that I think I would hope you would focus on is the approach of requiring the auditor, not giving him the option, as people can presently do with emphasis paragraphs, but requiring the auditor to report on critical audit matters, those matters that gave the auditor the greatest difficulty. One of the things that is, to me, appealing about this standard is that it allows the auditor great discretion in professional judgment. It doesn't tell him exactly, except for the very broad standard, it doesn't tell him what he has to do, but gives him a standard. It constrains that judgment, however, with an objective standard that basically says that when you identify these critical audit matters, if these are matters that you believe a, quote, reasonable and experienced auditor would also find to be a CAM, and you conclude that this is not a CAM that has to be disclosed, you have to document this. The reason it is particularly important here to have the judgment of the objective auditor is that it allows quality control people within the audit firm who are looking at this, and it allows regulators like the PCAOB to impose a standard to say, okay, you did not do this when a reasonable auditor would have done it, therefore there is a failure here. So reasonable man standards are well established in this society. They underlie much of the legal framework we have in various areas. So I think this is a very good way of balancing the auditor's discretion. So I think that's, that is a very good thing. I want to talk just briefly about auditor tenure. I frankly don't know whether auditor tenure is related to auditor quality or not. But my personal belief is that the more information we can provide investors, particularly without great cost, the better it is. And that there may be investors who find, and users of financial statement, who find the auditor's tenure to be relevant for a variety of reasons. It may be questions of corporate governance, they may have concerns about independence after long tenure. There could be a variety of reasons. But it is better to give that information than not to give it, and let investors decide themselves whether it's useful or not. It doesn't cost anything or very little to provide that information. The information is, in fact, in many cases already available through filings, but it's very difficult to get to. So I am totally supportive of having this information in our standard. Finally, on the other information standard, part of the reason I support this is that we're having the auditor now basically read the other information that's in an annual report along with the financial statements to say if it's inconsistent or contains misstatements of fact. Many auditors already do this, particularly in larger companies, and report it to the audit committee. What this proposal does is it now regularizes it for all public companies. It provides standards and procedures that will again be regularized, and it provides a disclosure to investors. So this goes not only to audit committees, but to outsiders. So for all these reasons, I strongly support this proposal.
Board Member Harris.
Thank you, Mr. Chairman. I am on record about the critical importance of changing the auditor's report. I support publication of the proposed standards to stimulate public discussion about their content. But I remain concerned that the proposals are not strong enough to meet the needs of investors. My views are based in significant part on what our PCAOB Investor Advisory Group has told us. The IAG Working Group on the Auditor's Report and the role of the auditor presented survey results in March 2011 on the usefulness of the current Auditor's Report. The survey respondents included officials of various institutional investors representing well over $8 trillion of funds under management. The results illustrate the changes to the Auditor's Report investors believe are appropriate. 79% of the respondents identified a need for information about the auditor's assessment of management's estimates and judgments. 67% sought a discussion of unusual transactions, restatements, and other changes. And 65% identified the auditor's assessment of the quality of the issuer's accounting policies and practices. The proposals we are considering today have several parts. First, they would require additional information about the auditor's independence, tenure, and responsibilities for fraud and financial statement notes. These are welcome changes, especially in light of the history of concerns about the impact on independence of the issuer pay model, the potential for auditor capture in long-running engagements, and the need for clear understanding of the auditor's role. In addition, and most significantly, the proposal requires an auditor report on what she or he has identified as critical audit matters. These are issues addressed during the audit that the auditor determines involve the most difficult, subjective, or complex audit judgments, pose the most difficulty in terms of obtaining audit evidence, or pose the most difficulty when forming his or her opinion on the financial statements. Such a change, if conceived and expressed carefully, might well alter the landscape of the audit report and go a substantial way to meeting the need for communication of areas of high risk, of high audit risk. The language in today's proposal, however, does not appear to me to create a rule that will be sure to do that. There are three reasons. First, the language endorses a subjective standard in determining what a critical audit matter is. It is what the auditor determines it to be, not what it might be seen to be objectively. Significantly, although it is expected that in most audits the auditor would determine that there are critical audit matters, the proposals make clear to an auditor that he or she need not report any if the work paper documents the reason for not doing so. Therefore, even if a matter were important enough to, quote, appear to be, close quote, a critical audit matter, and were communicated to the audit committee, discussed with the engagement quality reviewer, or documented in the engagement completion document, it could be left out of the auditor's report. Second, whether the new disclosures will really tell investors anything will depend a great deal on how plainly and directly they are written. Third, I have some concern that effective inspection and enforcement of compliance with a subjective critical audit matter standard will not be possible. I agree that auditors are not and should not become financial analysts or investment advisors, but the events of 2006 through 2008 continue to reverberate for the world economy, and they are a cautionary tale. When companies plunge in value or requirement government takeover, shortly after receiving the same clean audit report year after year, investors can lose confidence, understandably, in the audit process. Dealing with that problem means going further and changing the audit report. Sir David Tweedy, the former chairman of the International Accounting Standards Board and national technical partner of KPMG, suggested that investors should learn through the report what kept the auditor awake at night, 2, what arguments the auditor had with the CFO, 3, what the big estimates are, 4, what the contentious accounting policies are, and 5, what the going concern assumptions are. I do not believe that the proposals we are considering this morning deal with some of the important questions he raises. Indeed, having the auditor concisely discuss a precise list of issues of interest to investors, as suggested in the IAG survey and similar surveys by the CFA Institute, an institute comprised of more than 115,000 certified financial analysts, may well be preferable to a discussion of only issues that auditors, in their discretion, determine to be the most difficult, subjective, or complex ones in an audit. Of course, the two sets of issues may overlap, but they may well not. I believe we should be seriously considering a requirement that auditors also report on any matter that would otherwise be of greatest significance to a reasonable investor in understanding the import of the financial statements. And we should be considering requiring specific discussion in the auditor's report for particular items of the sort Sir David and the IAG survey and CFA Institute surveys have identified. I hope we will receive detailed suggestions on these questions. We are also considering this morning a proposed standard on the auditor's review of other information contained in annual reports made under the Securities Exchange Act of 1934. The proposed standard would require the auditor to communicate his or her responsibilities regarding the information included in the annual report that is outside the audited financial statements and the related auditor's report, and the results of his or her evaluation of that information. The proposed other information standard requires that the auditor read and evaluate the other information as opposed to the current requirement of read and consider. The scope of the proposed other information standard would continue to only apply to annual reports filed under the Exchange Act. Registration statements filed under the Securities Act of 1933 in connection with the sale of securities to the public are not subject to the proposed procedures. I hope we will receive comment on this difference of treatment, which I view as difficult to justify given that the Securities Act registration statements contain information for investors considering making an investment decision in the first place. I would like to offer a final thought. The challenge of this project is to find a way to balance the need for a different, more useful and communicative model of the auditor's report with the need not to change what auditors do, but to change how they report on what they do. Today's proposals are a step in that direction. As I have said, however, I am not sure they meet the challenge as well it needs to be met in light of the board's mission to protect investors. I know investors will speak for themselves in filing comments that address the issues that the proposals raise that I've tried to highlight this morning, and I look forward to a careful consideration of all comments we receive. I join the other board members in thanking all of the staff in the various offices and divisions that have contributed to getting this project before the board. I want to particularly thank Marty Baumann and the staff members in the Office of the Chief Auditor, the Office of the General Counsel, and the Office of Research and Analysis that have been involved. Most people are not aware of the tremendous staff time and effort that goes into these proposals. I would be remiss if I did not single out, as others have, Jessica Watts, whose contribution. Jessica has been the lead OCA staff member from the project's inception, and her dedication and hard work, including putting in many long nights and weekends for many months, has been critical. And I also want to thank, as the chairman has, the staff at the SEC for their thoughtful input. Another person that I want to acknowledge today is Bob Burns. Bob is leaving the PCAOB at the end of this month after being with us for nearly 5 years. Bob's public service spans 30-plus years, beginning with the Judge Advocate General Corps in the Army, then at the SEC, where he served with distinction for over 20 years as Chief Counsel to the Chief Accountant. Bob's work while at the SEC and here has always been with a view towards investor protection. Bob was especially helpful when we were establishing the Investor Advisory Group in 2009. I personally have never met a more dedicated, self-effacing, and competent public servant. And Bob, we'll miss you and your wise counsel. Thank you, Mr. Chairman.
Board Member Hanson.
Thank you. Good morning. Today's proposal to expand the content of the auditor's report and to issue a new auditing standard governing other information in annual reports is an important step in a long journey toward improving the usefulness of the audit report. We are only at the proposal stage, and I see today's action as a starting point for more discussion. In many respects, these proposals have attributes of a second concept release. We will review carefully the written comments. We plan to hold a roundtable to seek additional feedback. It is possible, if not likely, that we'll have a re-proposal before we adopt any new standards in these areas. Thus, while I support the need for these proposals to start that discussion, I do have questions about certain aspects, and I'll highlight a few of those in my comments here. For the auditor's report, let me begin with a few words about that. Arriving at today's proposal took a lot of time and effort. The staff and the board considered a wide range of options, starting with the 4 alternatives discussed in the 2011 concept release, and including a variety of other potential approaches, including those proposed by regulators and standard setters in other parts of the world. I believe that the result, requiring disclosure in the auditor's report of more information about the audit, but leaving to management the disclosures related to the financial statements, has the potential to achieve our goal of balancing the desire of investors for more information while not having the auditor overstep into the realm of management responsibility or investment analysis. The proposed expansion of the auditor's report to include critical audit matters, where applicable, is a first attempt to be responsive to investor demands for more information from auditors. The discussion of critical audit matters will not, however, be a silver bullet that will help avoid or predict future economic crises. As defined, critical audit matters are those matters addressed during the audit that involved the most difficult, subjective, or complex auditor judgments, pose the most difficulty to the auditor in obtaining sufficient appropriate evidence, or pose the most difficulty to the auditor in forming the opinion on the financial statements. Thus, they are a window into the audit intended to provide more information about the difficulty faced by the auditor in connection with providing assurance on certain information and complex aspects of the company's financial statement or internal controls. I think of it as telling investors what kept the auditor up at night. It's important to understand what the proposed standard does not require. That does not require reporting of all information known by the auditor in which investors may have an interest. Somewhat to Steve's point. There are risks and uncertainties inherent in the financial reporting process that may not be discussed as critical audit matters because the application of the accounting rules is clear, there are limited estimates required, and the audit process is relatively standard. For example, revenue is the most important number in the financial statements to most investors. But revenue recognition for some businesses, I'll think of a restaurant, is very straightforward and may not be identified as a critical audit matter. Likewise, there may be critical audit matters reported that bear little on an investment decision. Overall, I believe the proposed enhanced reporting will add context to the mix of information available to investors for consideration in their investment decisions. In order to ensure that our proposals accomplish this objective most effectively and without adverse consequences, I'd like to highlight a few specific aspects of the proposal and raise several questions that I believe merit particular attention by commenters. First, one potential concern I have with the reporting of critical audit matters is that discussion in the auditor's report of these matters could result in disclosure by the auditor of information that specifically was exempted from disclosure by other applicable rules and regulations. By way of example, the determination that a deficiency in internal controls is a significant deficiency rather than a material weakness may have been a critical audit matter. Under applicable securities law and SEC regulations, depending on the circumstances, a company may not have to disclose a significant deficiency, but the critical audit matter discussion in the audit report may cause that information to be disclosed. Similar non-required disclosures could result in connection with going concern considerations. The current standard expressly requires the use of a phrase like substantial doubt about the entity's ability to continue as a going concern whenever the auditors reach that conclusion. The current standards also prohibit conditional language like, if the company continues to suffer losses, there may be substantial doubt about its ability to continue as a going concern. Is a critical audit matter that discusses considerations like possible losses, therefore inconsistent with current standards? Will this result in confusion? Are there any unintended adverse consequences associated with this possibility? If so, what, if anything, should the board do about it? I also question whether it's appropriate for the board to require disclosure in the audit report of the auditor's tenure with a particular client. We explained in the release that in developing the proposed statement, the board has not reached a conclusion regarding the relationship between audit quality and audit tenure, and that the board's inspection process was not designed to determine a relationship between audit quality and audit tenure. Thus, we do not at this point have any data indicating that audit tenure has any correlation with audit quality. The mere fact that the board requires a disclosure about audit tenure, however, might suggest the board believes the information to be meaningful. Do commenters share this concern? Would inclusion of this information cause readers of their audit report to draw unwarranted inferences? Given that information about auditor change is publicly available for many companies on the SEC's EDGAR database going back almost 20 years, should the board nevertheless require this information to be included in the auditor's report as a matter of transparency and in the interest of more disclosure? Finally, a note on the proposed auditor reporting standard suggests that in most cases, auditors will report critical audit matters. This provision is intended to convey the board's belief that most audits involve consideration of complex and difficult matters and the expectation that auditors report on those issues in the audit report. I generally agree with this belief and expectation, but we have not conducted specific research to support this point. Are there audits of smaller, less complex companies that routinely do not involve any complex issues or judgments and present no difficulties gathering audit evidence? Would inclusion of this note in the proposed standard as written cause auditors to believe that they must come up with critical audit matters for every audit report, no matter how straightforward the audit? What would be the potential adverse consequences of that result? Finally, let me say a few words about the proposed documentation requirement in the standard. As drafted, auditors must document their determination of critical audit matters. This includes not merely a requirement to document why particular issues were determined to be critical audit matters, but also why other areas that would appear to meet the definition of a critical audit matter ultimately were not included in the auditor's report. In the release, we explain that this documentation requirement is not intended to be overly burdensome. We do not expect auditors to reference every single matter included in the engagement completion document or the communication of the audit committee and explain why such matters do not constitute critical audit matters for the purposes of the proposed standard. Rather, the expectation is that the auditor address those issues that a reasonable experienced auditor would believe to be critical audit matters and document why determination was made that they are not. I'd be interested in hearing from commenters about whether this requirement is sufficiently clear, whether it's practical, and whether the board should consider alternative or supplemental language in the standard. Let me turn to the standard on other information. As a general matter, I support the need for clarity about the auditor's responsibility for other information included in annual reports. I support today's proposal as a step in that direction, but I believe we could benefit from input on a few specific issues in order to refine the approach. As members of the Office of the Chief Auditor already explained, the proposed standard is limited in scope. As drafted, the proposed standard would require the auditor to perform procedures on certain types of information that is outside the financial statements but is included or incorporated by reference in annual reports. The actual procedures by the auditor would also be limited. The proposed standard does expand the auditor's responsibility from read and consider, as required under the current AU 550, to evaluate whether the other information contains a material inconsistency with amounts or information or in the manner of presentation in the audited financial statements and or a material misstatement of fact. The auditor's responsibilities are limited, however, to basing this evaluation on relevant audit evidence obtained or conclusion reached during the audit. In other words, if the auditor, through the performance of the audit of the financial statements or review of internal controls, did not gather information or evidence to which to evaluate the consistency or truthfulness of the other information, the auditor need not go further. In practice, that means there may be other information in the relevant documents that is important to investors that the auditor will not evaluate. Examples may include operational statistics provided by the company in order to explain the success or lack thereof of the business, such as number of new customers, key improvements in product features, maybe new products in the pipeline, registered users of a website, number of patents granted, etc. In many cases, the audit work papers do not include data related to such disclosures, and the auditor may have no way to evaluate the information. Combined, do these limitations on the other information standard increase rather than decrease the expectation gap between auditors and investors? Will investors understand the limited universe of information and documents to which the proposed standard would apply? Will investors understand what the auditor actually did with respect to the other information? Will they understand the auditor is unlikely to have information or audit evidence to substantiate some of the numbers reflected in the other information? Are there changes the board should consider in making the proposed standard to eliminate this potential expectation gap? Likewise, the concept of the auditor evaluating the other information may have potential to cause some confusion. The auditor's work to evaluate the information will not constitute what is normally understood to be an audit, nor is it the same as a review. What level of assurance, then, does the auditor provide by conducting these procedures? Will this, too, increase the expectation gap? Finally, I believe that many audit teams, particularly at the largest firms that audit the vast majority of the U.S. market capitalization of issuers, may already perform many of the procedures proposed to be required in the other information standard. If true, this may imply that new audit costs arising out of the proposed standard would be minimal. It also suggests, however, that investors and companies audited by these largest audit firms should not expect a change in the really level of assurance they are being provided in connection with the other information included in the annual reports. I'd be interested to hear from firms, large and small, to what extent the other information proposal will affect the current audit process. Do firms already largely satisfy the proposed requirements to evaluate the other information, and are there incremental changes we should consider to the proposal? Turning for a moment to economic analysis, I'm encouraged that the PCAOB is devoting more time and attention to the economic impact of our standards and rulemaking. We've hired an economist to assist our chief auditor and plan to hire more. Our economists in the Office of the Research Analysis have devoted substantial time and attention to the economic impact of these proposals. We recognize the need to further develop our models for evaluation and formalize a consistent methodology and guidance. These proposals contain discussions of economic theories and academic studies. It's all a good start. However, we need to hear from investors, preparers, auditors, and others through the comment process about whether the potential economic benefits of the proposals discussed are realistic. We also need comments about the nature and extent of potential costs of the proposals as well as unintended consequences. In closing, I'd like to ask for help from investors, auditors, audit committee members, and potential commenters. I would like to encourage a dialogue among audit firms, management, audit committees, and investors to discuss our proposals and to foster better understanding among everyone about potential costs and benefits. As some of my fellow board members have pointed out, the proposed change to the audit report represent a dramatic shift for the auditing profession. It is important that the board consider all relevant viewpoints and we obtain the best feedback possible in order to help us refine our approach going forward. I would particularly like to encourage auditors to work with their clients, audit committees, and management to perform some voluntary mini field tests where the engagement partner, maybe the EQR, management, and the audit committee each independently consider what issues they may consider constitute critical audit matters under the proposed standard. Provide feedback in your comment letters about this experience, including whether there was consistency with respect to the critical audit matters identified. I'd also be interested in hearing from auditors who have attempted to draft the necessary discussion of critical audit matters from particular engagements. Perhaps share the language with your client's management and audit committee and ask them to provide feedback to the board. Let us know the degree of effort and/or difficulty you encountered in doing this exercise. Share your drafts with us if you can. Please even share them with investors to obtain their views on the usefulness of the information. Finally, I'd like to join my fellow board members in thanking the staff of the Chief Auditor's Office and the Office of General Counsel and the Office of Research and Analysis and everyone else in the building that helped. I won't go through the names. I think we've all covered those enough, and I would also like to express my thanks to the staff of the Office of the Chief Accountant at the Securities and Exchange Commission and others there that helped. As usual, they provided good food for thought and insightful comments.
Board Member Franzel.
Thank you, Mr. Chairman. Good morning. Today, the board is taking a step forward in the decades-long effort to narrow the gap between what investors would like to see in audit reports and what the auditor actually provides in the audit report. I fully support the board's engagement in examining the auditor's report and devising potential solutions to this, and I compliment the staff of the Office of the Chief Auditor, Office of the General Counsel, and Office of Research and Analysis for their hard work and, frankly, creative thinking reflected in this proposal while balancing so many competing factors. I think it's very important to realize that this expectations gap that we're dealing with, not only is it long-standing, but it's multifaceted. And in 1978, the Cohen Commission report confirmed the existence of this expectation gap, also labeled it as multifaceted and historical. So therefore, it's going to be difficult to close this gap with one proposal, and the auditors alone are not going to be able to close the gap. In fact, academic research describes the expectations gap very broadly as the difference between information that's provided in the financial statements and the auditor's report and the desires of investors and others for information. So part of the difficulty of this project was really breaking out the audit piece and looking at the many competing factors, which I believe the staff did a very good job of doing that, looking at the distinction between management's responsibility for financial reporting and disclosure versus the auditor's attestation role. And of course, investors' desire for more information both about the financial statements and the audits. And then the need to really look at potential risks, including potentially obscuring the distinctive roles between management and the auditor, potentially undermining the traditional value of the pass-fail audit opinion, competing interpretations of information in the financial statements, and potentially interfering with the role of the audit committee or stifling auditor communications. And so I believe the staff has done a very good job of balancing all of these competing factors and risks in order to come up with the proposal today. And it really is a new concept, and so I do reflect some of the comments of my fellow board members here, and that we really do need input on this, and we might very well need to issue another proposal after this. So this is a new proposal, or a new concept really, to try to balance all of these competing issues. So the proposed standard is intended to make the auditor's report more informative, thus increasing its relevance and usefulness to investors and other financial statement users. And the proposal anticipates that in most audits, there would be some disclosure of critical audit matters. And there are a number of fundamental questions about this approach that we're seeking input from commenters. For instance, would auditor reporting of critical audit matters provide investors with valuable information? How would investors use such information? Would this type of information help alleviate the asymmetry that exists between information that company management has and investors? And if so, how? Would the audit-specific approach of reporting critical audit matters result in unintended consequences? For instance, would auditor reporting no longer be comparable or consistent across entities, and would that cause problems and complications for investors and other users of financial statements? Or would the value of this additional information provided through critical audit matters outweigh any such potential challenges? Finally, what are the implementation challenges and cost considerations presented by this proposed approach? Regarding the auditor's responsibility to report on other information in the annual report, the standard is intended to respond to investors' interests in obtaining enhanced information and enhanced assurance from the auditor on this other information included in the report. And again, there are a number of fundamental questions about this standard for which we are seeking feedback. Are the objectives and scope of the requirements sufficient to improve the auditor's identification of material inconsistencies and material misstatements of facts in this other information? Are the auditor's requirements to evaluate certain aspects of the other information clear? To what extent would the auditor's evaluation and communication about this process increase the quality of information available to investors? And could this approach actually increase the expectations gap, or would the auditor's performance of these additional procedures and additional reporting reduce the expectations gap and provide additional beneficial information to investors? So again, a lot of fundamental questions for which we are seeking feedback. And then there are other changes proposed in the standard, clarifications to the standard language in the auditor's report, while maintaining certain basic elements of the existing report, along with new elements in the report, including additional language about the auditor's responsibility for fraud and information about auditor tenure. Regarding auditor tenure, the proposal would add a new element to the report dealing with tenure, basically a statement containing the year the auditor began serving consecutively as the company's auditor. The release states that investors and other financial statement users have indicated a strong interest in this information, and I support disclosure, but the academic research on the impact of auditor tenure on audit quality is inconclusive. And furthermore, after extensive outreach and research on the issue, including consideration of PCAOB inspections, the board has not found evidence that would allow generalized conclusions about the impact of auditor tenure on audit quality. So therefore, I have some concerns about including this in the auditor's report because it might lead to conclusions that it should be interpreted in a certain manner. So the real question is, does this disclosure belong in the auditor's report, or is there perhaps some other mechanism to disclose this information. Perhaps it should be disclosed by the audit committee or in some other venue. Plus, this information is available publicly. So the board asks a number of questions about this issue. In closing, this is a significant proposal that represents a very important step forward in examining the auditor's report. I applaud the staff for their critical thinking, and I look forward to the comments. I think this will be a very important process to get comments from stakeholders. And again, I think we'll find ourselves balancing the differing views and information that comes in. But again, I think this will be very important in terms of coming up with a final proposal on this. So I want to thank, again, the staff for their hard work. I know the hours have been crazy the last few weeks, and I hope that after today, you all can get a little bit of rest before the next project comes in. Thank you.
All right, question time. Recognizing that compound questions are an innate liberty of the questioner, please, if I can prevail on my colleagues to confine their compound questions to two-part questions and not string them into 3- and 4-part questions, I think we'll be out of here in good order. Mr. Ferguson.
Well, maybe I'll start my question with one word, a one-word question, boilerplate. And specifically what I mean by that is how, one of the concerns I have here is that because of the need for quality control and uniformity, particularly in large firms, that very quickly the disclosure of critical audit matters will degenerate into something that's formulaic and does not communicate anything. For example, you could imagine a critical audit matter in every large financial institution saying, one of the critical things we had to spend time on were the loan loss reserves, but it'll be a uniform disclosure that really doesn't convey anything. How do we avoid that?
Well, it certainly is a concern, and we've addressed that concern and that risk in the proposed documents. We've also indicated that we require the auditor to identify the specific considerations that led him or her to determine that the matter was a critical audit matter. And we give some hypothetical scenarios that we think are very important for readers to take a look at. We describe in these hypothetical scenarios the situation in the company, what the company's proposed footnote looked like, and therefore what we think the critical audit matter disclosure should be. If you take a look at the hypothetical examples we've given, they're far from boilerplate. They're thorough discussions of the situations that gave rise to that. I'd hope if you think back, and comments were made about the financial crisis, if you think back to the 2007s or something like that, where some banks were starting to make loans with different underwriting standards that they didn't have history on. We're starting to make loans based upon not needing income verification or asset verification. Loans that would be negatively amortizing. That suddenly the auditor, in describing why that allowance for loan losses in your example could be difficult to estimate, would include facts such as we don't have experience and management didn't have experience in determining the allowance for loan losses for this type of product. So a new product was introduced that had very different features than historical underwriting had shown in the past, and therefore historical experience wasn't there for us to determine the allowance. So management had to come up with new inputs and new assumptions and used new models to determine that allowance. We, the auditor, had very difficult judgments in evaluating that evidence, and it was very difficult for us to obtain evidence that those were reasonable assumptions and estimates, and used specialists and other manners and consulted with our national office to determine our conclusion with respect to that area. So I think, some of the examples we give include that type of information. So our expectation is that the auditor's discussion will be very specific to the circumstances of that particular audit as to why that matter is a critical audit matter and avoid boilerplate. Having said that, the risk exists. We'd like to hear what commenters say about that, certainly, in this comment process. And as some have pointed out, this is the first step. If we think that's going to be the case, we'll have to take a look at this and determine what words we have to change in this.
Mr. Harris.
Mr. Chairman, did I understand we're going to have a number of rounds?
Yeah,
So
that's
therefore,
until-
we shouldn't compound the questions.
Until board members
So
confess exhaustion.
out.
Yes.
Okay, as I mentioned in my statement, the proposed definition of a critical audit matter is subjective and based on the auditor's judgment. My question is, why does the staff believe that this approach is appropriate, and why shouldn't the auditor be required to discuss in the auditor's report the significant risks identified during their audit, something that is required by our standard AS-12? And in this regard, I note, for example, that the June 2013 auditor's reporting requirements set forth by the UK's Financial Reporting Council require the auditor to discuss the identified assessed risks of material misstatement that had the greatest effect on the overall audit strategy, the allocation of resources in the audit, and directing the efforts of the engagement team. So my question is, why aren't we requiring the same or something similar?
Well, I'll take this one as well, but we'll start to disperse these questions in a moment. We think that certainly significant risks that the auditor addresses would, in many cases, likely result in critical audit matters that the auditor addressed. Again, we're asking the auditor to address the most difficult and complex judgments that were part of that audit, and those are normally related to significant risks. Significant risks are often discussed in the AS3 completion document, reviewed by the engagement quality reviewer, who has to review the significant judgments of the engagement team and report it to the audit committee. They form the basis for how the auditor determines what are critical audit matters. We think actually critical audit matters is something broader than significant risks. Significant risks, as defined in our literature, include anything that's a fraud risk. Revenue recognition is presumed to be a fraud risk. Risk of management override is presumed to be a fraud risk. So to some extent, if one was required to disclose significant risks, you could wind up getting a list of boilerplate, and that every single audit they'd be discussing revenue recognition was a significant risk. Risk of management override was a significant risk. And of course, there would be others as well. But so we think that this takes into account significant risks, includes the nature of those and the types of matters that would be critical audit matters. And that was the basis for our conclusion.
Mr. Hanson.
Well, I'll ask a semi-compound question, which is, question is really around, in practice, how do we think this is really going to work in terms of the screening down from the potential universe of issues to talk about, getting down to the list of potential CAMs and then actually deciding on it, and the documentation exercise, and will this all just be piled on to the end of the engagement, which is typically frantic anyway, or do we think that some of this can be thoughtfully considered throughout the audit, and the end of the engagement's not going to be that affected? So just kind of walk us through some of what you're thinking about practically how this is going to work.
I'd be happy to take that semi-compound question. First, you asked about how will it work as far as the auditor's determination of critical audit matters. Those of us that worked in the Office of the Chief Auditor on this project are former auditors. And so in our view, we expect that auditors would know which were the matters that kept them up at night, what were really difficult, what do they think they needed more evidence on, what were the estimates, the judgments that were very difficult, and issues that are difficult in forming the opinion. So those type of issues, we believe the auditor would know. But with that said, the standard does provide sources to help the auditor in making sure that auditors are thinking about it consistent with the expectation outlined in the proposed standard. So we advise auditors that ordinarily critical audit matters are matters as such that they would be documented in the document completion memorandum, that they would be matters that are significant importance, that they're part of the discussion, the review by the engagement quality reviewer, and also communicated to the audit committee. So auditors could look to those sources to identify, review which matters. There may be something that they might think might appear to be, they might have their top list, but something that it might appear to be. But also we have a list of factors, and the factors help help auditors think through what we're thinking, our expectation in terms of what would meet the definition of a critical audit matter. So talks about, Marty mentioned, use of specialists or consultations that were involved, matters that were difficult obtaining evidence, matters that required significant judgment. So those are the type of factors that should help auditors in determining which matters. We are interested in comments on that. It's our belief. We're not expecting it to be a significant exercise, but recognize certainly this would be something that would be new. So as you mentioned in your remarks, encouraging auditors to go back and reflect, think about prior experience, we think that would be very helpful to see if they have a different view or what their thoughts are and what the exercise would be like in determining matters that would be a critical audit matter, at least as we've defined them in the proposed standard. You also asked about what would happen at the end of the audit. Would this happen all at the end? We expect that in most companies, and even our standards encourage timely communication discussions between the auditor and the company and the audit committee throughout the year. Certainly our new audit committee standard encourages timely communication starting with planning throughout to the completion of the audit, but also auditors are responsible for quarterly reviews, and often in many engagements, auditors are very involved. So we expect that for many audits, it should not be something that should just happen at the end. That we would expect issues would come up during the year. They might recognize certain issues that might appear to be significant issues at the beginning. And as they continue on in their experience through the audit, should be aware of those things. It is likely that something could come up at the end, so that would be something, but we would expect that it wouldn't be, at least in many audits, a last-minute process. There are, of course, with that said, very small engagements that auditors sometimes complete in a period of just 2 weeks at the end of the audit. So for those types of engagements that are very small, then of course it would be something at the end of the audit, but they're doing principally everything at the end of the audit. But we are interested in comments from commenters on timing and considerations and other challenges as well.
Ms. Franzel.
Has the staff considered pilot testing or case studies, some way of testing this out as we enter into the comment period and beyond, in addition to, getting comments on the proposal? Are there other ways of getting input on how this would work, and what are your thoughts on that?
Well, Board Member Hanson has asked for a lot of information in that regard, and asked for a lot of volunteers to try to take prior year's audits, for instance, I guess, and look at what the critical audit matters might have been, and maybe discuss those with the audit committee and see how views, what that experience shows, and to take that experience and include that in the comment letter. I think that's good advice. We did ask specifically in the proposal for examples of what people think a critical audit matter would look like, hypothetical examples or examples from their experience. Certainly, if it's those things would wind up as part of the comment record. So if it's something that someone doesn't want disclosed, I guess they wouldn't put that example in for now. But so we are asking for examples of those, and I think the recommendation made by Board Member Hanson makes a lot of sense. At the same time, we'll be looking at the experiences that are taking place with others. There are requirements, as was mentioned by Board Member Harris, that in the UK, there are some requirements already going into place for certain types of disclosures, and we'll see how that's playing out as well. But certainly we're interested in the comment letters we get. There's a similar proposal out from the International Auditing and Assurance Standards Board. We'll look at those comments also. But so those are the types of ways we'll try to see. But we don't have a specific board authorized monitored field test designed at this point in time.
Back to you, Mr. Ferguson.
Do you want to ask a question? You want to ask a question?
No, I'm happy with the answers we're getting in response.
Okay, you have as part of your proposal here, when a CAM or something that looks like a CAM, walks like a CAM, talks like a CAM, the auditor decides it's not a CAM, he has to document that. in light of the litigation climate in the United States, do we seriously believe that that will be anything other than a null set, that any auditor would ever document a decision not to disclose something as a CAM in the event that things later go wrong? And that was the area where the problem was.
Well, it sounds like from your experience as a counsel that you might be recommending that they don't have any of those.
I mean, it just seems to me the risk-reward ratio in that category is completely unbalanced.
So here's why we have that requirement. Certainly, the CAM itself will provide a lot of reasons. Critical audit matters, the disclosure of that will say what were the considerations that led to that critical audit matter, and that will be certainly part of that disclosure. However, there is the concern that what would be missed by the auditor, what might be left out. Could there be management pressure to not include something in the critical audit matters? So we've decided that it was important to have a documentation requirement. And we thought long and hard about this documentation requirement. One could be simply take everything that's in the audit committee report or reviewed by the engagement quality reviewer and say why it is or isn't a CAM. We thought that could be a very burdensome documentation requirement. Instead, we went down a path, although we're asking questions about that, should the documentation requirement be broader than it is? The use of the experienced auditor is in a number of places in PCAOB standards. And what this says is, there's a question just asked before by Board Member Hanson. I think auditors, in looking at their results of the work, will say, right, so these matters clearly are critical audit matters. But there are some other matters that they dealt with that had tough judgments and some tough difficulty getting evidence. And there'll be a line somewhere where the auditor has to, draw as to what is a critical audit matter and what is not. And I believe firms will develop methodologies as to how to draw that line, and also the firms will want some documentation about what was your thinking as to why these were and these were not. And so what we're saying is those that were not, if they would appear to an experienced auditor based on the surface to be a critical audit matter, then hey, they should be either in critical audit matters or documented as to why you drew the line to say, I didn't think they had to be disclosed. So that's the formulation of the documentation requirement at this time. I honestly would expect that firms would have to be cautious to say those that are on the side of the line that are not being disclosed, to have some documentation about those close calls as to why the auditor thought, I don't have to disclose those. So that's the nature of the requirement, and we'll just see what commenters say.
Mr. Harris.
Following the lines of my first question, the current auditor's report specifically mentions the auditor assessing the significant estimates and judgments and evaluating the accounting principles as part of its basis for its opinion. Why shouldn't the auditor be required to discuss his or her assessment of such matters in the auditor's report as suggested by some investors?
Well, certainly the auditor assesses significant judgments and estimates as part of formulating their overall opinion on the financial statements. One of the things we wanted to avoid was not providing piecemeal opinions on individual estimates or judgments, so we didn't go down that route. Didn't require, and then I talked before about the fact we decided for the audit, this proposal would be about the auditor talking about the audit and the auditor's difficult evaluations and judgments. So I believe in many cases, the auditor will be talking about those difficult judgments and difficult estimates and why they were difficult, and historical information, for instance, that made that estimate difficult to obtain evidence about. So I believe there'll be a lot of information for investors about those significant estimates as part of the audit. So I believe that we'll get that there. I don't know, Jessica or Jennifer, do you want to add to that discussion at all?
I think you covered the significant things. Just what comes to my mind is that estimates, can have a lot of significant They do. I think, as you just mentioned, a lot of significant judgments and estimates. So what does auditor's assessment mean? There is no definition. Ultimately, they have to form an opinion on whether the financial statements are fairly presented or not. So our approach really, in my view, gets to talking about having the auditor communicate those type of things about estimates. I would expect that significant estimates, like Marty's example of allowance for loan losses, which is an estimate, would be communicated as a critical audit matter in the auditor's report. With that said, interested in comments on our approach, but I think it will get to many of the things that you're talking about in connection with assessment of estimates.
Yeah, I believe the critical audit matters will be about estimates. Of course, the financial statements are all about estimates, and so I think that's what the critical audit matters will be about. But our approach was not to have the auditor comment on the financial statements, or to comment, if you will, on the auditor's view, because there's no basis in our standards to make such a view, or in Financial Accounting Standards Board standards, as to where on the range of acceptability a particular estimate fell. And we think we get great inconsistency if auditors started to go into a free-form analysis of what they thought about a particular estimate. So again, we decided to go down the approach in this proposal for the auditor to talk about how the auditor viewed those estimates from whether or not they were critical audit matters or not.
Mr. Hanson?
I'm going to put Andres on the hot seat for a minute. We haven't talked much here publicly about economic analysis, and I mentioned in my statement that we've got a lot of discussion in the document, and in several places throughout we refer to academic studies and some of the theories about the benefits that will accrue to investors from this. And if you could maybe just summarize for us some of the underpinning of the economic theory behind why this additional information will help investors and what the real benefit is. Because information is only good if it's going to benefit somebody. So, want to just give us a brief education on economic theory and how we're approaching the assessment?
Well,
You're good.
You're good.
good morning. Let me start by saying that let's start by CAMs. Auditor commentary on CAMs effectively reduces the information asymmetry that is happening out there between management and the investor. How would that work? CAMs are designed to, as you put in your statement, bring to light to investors what keeps the auditor at night. We think that is important information that the investor will use in her investment process. CAMs by design are focused on factors that reduce uncertainty in the estimates that investors already are using in their investment process, going beyond the customer information that they already look in financial reports. Thus, the critical audit matters should provide new information that helps investor in their task of investing. Now, we have reason to believe that this newly learned information would be valuable and not excessively noisy, and would reduce rather than increase investor uncertainty. This for three reasons. First, there's evidence that even today, auditor commentary contains valuable information. Research shows that auditor commentary today under AU 508 tends to provide information that can help an investor predict events such as restatement. We are providing more of that type of information to investors in this proposal. Second, on the demand side, time and again, research in finance shows that markets tend to incorporate this valuable information that we're talking about here today swiftly and rather efficiently into market prices. The overwhelming pressures of a competitive marketplace for financial assets ensures that new information, however obscure, is eventually incorporated by clever and sometimes sophisticated investors, making prices more accurate, and this, by the way, benefits all investors, regardless of level of sophistication. And finally, on the supply side, we believe that auditors will have the incentive to send non-confusing signals. If signals are confusing on those CAMs, we believe that investors and companies would demand more clarity from auditors in order to dissipate doubts, and everyone has the incentive to do so. There might be an initial phase where there's some volatility until people get it right. But we believe that this will happen only at the beginning of the implementation of the new standard, should we decide to do so. Let me talk for 1 more minute on other information. The idea there is to reduce possible inconsistencies between the numbers and other information that the auditor traditionally has less provides less assurance upon. The idea there is to improve the precision of information. Investors already have the set of information available to them. If there's dissonance between the information in 2 places, that introduces noise, and investors are confused and tend to put a discount premium in their investment process for those financial assets. To the extent that we reduce those uncertainties, investors will increase their level of comfort on financial statements, and thus companies will enjoy, on average, a lower cost of capital. So it's a little more than a nutshell, but that's my answer. Thank you.
Member Franzel.
One of the factors that you considered, or that you stated in your opening statements that you considered in developing this standard was, the proposed standard, was to not interfere with the role of the audit committee. But could you talk a little bit about how you see this proposal playing out in the audit committee's governance process and communications with auditors, and the auditor's communication with the audit committee?
Well, we first of all agree with that. It's an important part of the assertion in our proposal that we think it's the role of the management and the audit committee to have oversight of the financial statements, and additional auditor commentary or remarks about the financial statements could introduce noise and confusion. We would expect that, as was said by Jennifer earlier, in most certainly large engagements, there is AS-16 encourages timely communication between auditors and audit committees about the significant risks and significant matters being addressed by the auditor. So I don't think the critical audit matters will be a surprise to audit committee members, certainly in most large engagements, to those audit committees that are engaged and doing their jobs. I think they're well aware, certainly management is well aware of those areas where the auditor is having significant difficulty getting evidence, or really having a lot of discussions with management about how the management made their estimates and judgments. So I think there'll be significant engagement through by management and the audit committee with the auditor about these critical audit matters. And one of the benefits, potential benefits we point out, potentially, and we'd like to hear more about this, is that if management and the audit committee are aware of the fact that the auditor is going to point something out as a critical audit matter in their report, there's a good possibility that management may be more diligent in their disclosures and accounting for that matter in the financial statements, and certainly the auditor will certainly give that matter a lot of attention since it's being highlighted. So we do think there'll be engagement between audit committees and auditors about critical audit matters. We have a specific requirement, amendment to AS-16, that the auditor has to give the audit committee a draft of the audit report before the completion of the engagement with the critical audit matters in it. But I certainly hope and wouldn't expect that would be the first time that most diligent audit committee members would see or hear about those critical audit matters. It would be much more as part of the general discussions that take place between the auditor and the audit committee. Is that helpful?
Round 3, Mr. Ferguson.
I think this is probably my last question, but with respect to other information, I mean, what, to use the terms that we use in other areas of the audit, is the auditor providing any level of assurance when he does this review? And if so, what is the level of assurance?
Jessica Watts is dying to take that question.
Well, I'm glad I gave you an opportunity.
So the proposed other information standard would require the auditor to evaluate other information. And we use evaluate in our standards to mean that they've performed procedures and come to a conclusion. And then in this instance, we are just having them report their conclusion to the in the auditor's report. We have stated in this release that, and it's also stated in the standard in the auditor's report, that they're not performing an audit and they're not providing an opinion. So at this point, all they are doing is providing a conclusion on the evaluation.
So, but to tie that in with the word assurance.
Let me tie it in this way. The auditors obtain assurance. For instance, our standards require that an auditor plan an audit to obtain reasonable assurance about whether the financial statements present fairly. Then they give an opinion on the financial statements, or they obtain moderate assurance if they're going to give a negative assurance opinion on financials. In this case, the auditor is evaluating other information for purposes of then reporting. And what the auditor is reporting is not an opinion, but reporting his or her conclusion on the results and procedures of reading and evaluating that other information.
Did they find inconsistencies?
Did they find
the other
any
information with the audit?
Inconsistency? They're going to conclude whether inconsistencies between the other information and the financial statements, or whether material misstatements of facts in that other information based on, and this is a very important aspect, based upon the results of the evaluation of their audit and conclusions reached during their audit. So it's based upon the audit work that they performed. They do not have to perform additional procedures for non-financial information that they previously didn't get evidence upon in the audit. Having said that, we do cite an example in the document that a company, for instance, might say in its 10K that it has the #1 market share in a particular industry. That could be very significant information to the marketplace and might drive the stock price significantly, that kind of information. But the auditor might have been aware in looking at information as part of understanding the company and its environment that it lost its #1 market share and it no longer was, and it was struggling to compete with that other party. The auditor would likely then discuss that item with the company and say, we believe that information is not consistent with the information we learned as part of the audit, and would discuss with the management the need to change that information. If management didn't change that information, the auditor would make a decision whether they wanted to be associated with that audit and not have issue an audit report, or if they did, issue a report that indicated that there could be there's a material misstatement of fact about that company being the #1 market share in that industry.
Mr. Harris?
As been already noted and discussed, one of the new elements being added to the auditor's report is the auditor's tenure, which I strongly support. Would you discuss the consideration that went into having this included in the auditor's report, and what you think an investor should take from the disclosure of this information?
I think, as previously mentioned, there's a considerable amount of discussion going on around the world for certainly in the last couple of years, but certainly for the last many years, about the subject of auditor tenure. Most recently, in the United Kingdom, the FRC requires disclosure of auditor tenure, not in the audit report, but in a report by the audit committee. So there is a drive for more information about auditor tenure. There's great interest in the subject, and we believe that this was a valued data point for investors to see and to be aware of as part of the audit.
Mr. Hanson?
So my call to action for a mini field test for auditors and their clients and their audit committees to do. Let's say that there's an audit committee that says, "Wow, this is really informative. This discussion of a critical audit matter, and I've listened to Andres, and I think it's going to reduce my cost of capital." Could an auditor put that in an audit report today? Is there any prohibition on putting something like a critical audit matter in a report today if somebody wanted to do it?
We're certainly not encouraging auditors to go ahead and include critical audit matters in their audit report today. This is significant. As the chairman mentioned at the beginning of the meeting, the auditor's report hasn't changed in over 70 years. And our proposals today include some significant areas of change in the report. and we've included a number of questions throughout the release where we're seeking comment. So I think early adoption, including these types of matters in the report, would be premature for the market. Particularly, we're interested in a lot of considerations. And based on the extensive outreach we've been performing over the past several years, we already know that there's extensive differences among different parties about what would be useful, what would be not, and different views about the relevant importance or relevance of that information to users. So we're interested in feedback, but with that said, we very much would like commenters, particularly auditors, to go through the process of considering prior year's audits and considering what would the examples be. We are asking for examples, and any examples that are provided to us would need to be part of our public comment process. But we would encourage auditors to consider to reflect on their prior year's audits, and if they can, anonymize those examples in some ways of the types of example reports that they're seeing. But so I expect we'll get a variety of different feedback from different parties. And it's our view, and as we always do, we go through each and every comment very carefully, consider what everybody says in moving forward and what's the next appropriate step we're talking to the board about a next appropriate step for the PCAOB.
And I'll just go one step further. There is absolutely nothing in this document, in the proposal or its appendices, that would imply in any fashion that anybody should think about starting to disclose critical audit matters at this point in time.
Member Franzel.
I want to talk a little bit about the auditor's disclosure and explanatory language in the auditor's report when there's a substantial doubt about an entity's ability to continue as a going concern. So the standard retains the requirement to include that type of language when appropriate, but there are cases where that may also be a critical audit matter if it was a difficult call. So you might have both the explanatory language and the critical audit matter. On the other hand, there might be cases where there is substantial doubt for the entity to continue, but it was such an easy call that it wouldn't meet the requirements of a critical audit matter. So in one case, you might have an entity with a sort of two different disclosures about this issue, and in another case, just one. Can you talk a little bit more about how you see this playing out?
Well, I think the first thing you said is really important, and that is that existing requirements of other auditing standards prevail. So if an auditor is required in an evaluation of going concern, reaches a conclusion that there is substantial doubt, the auditor has to meet the requirements of that standard and have a paragraph that says, an explanatory paragraph, that there is substantial doubt about the company's ability to continue as a going concern. And that's true of other standards. Other standards still apply when there's required communications. Having said that, and I think as you pointed out, the auditor could determine to conclude in addition, an abundance of caution to say this was a critical audit matter, it was a difficult decision in reaching this, and here's some of the factors that led them to think about it. They can't in that way do any of the qualifying language that was talked about, things that, going concern language wouldn't otherwise let you do. One of the other issues, though, and I guess it is a simpler case where somebody could say they did not decide to put it into a CAM because it's so obvious that it's a going concern that they didn't make that disclosure. One of the things we do point out, and I think it was Board Member Hanson mentioned it, that there are certain cases where there are not disclosure requirements under accounting standards or auditing standards, that there is a potential that a critical audit matter could wind up nevertheless discussing that matter. One could be where the auditor struggled with the decision of whether or not this was a going concern and whether or not there was substantial doubt, but concluded that they didn't reach that standard where the auditor had to put that into the opinion. But nevertheless, the auditor felt it was such a critical audit matter, and whether or not the company was going to get the financing to succeed for another year, et cetera, was a very difficult decision, including other things that the company might do. It's possible, based upon the structure of this, that the auditor could discuss that in a critical audit matter. So we have raised that type of possibility in the proposal, and we've asked for comment about are there unintended consequences of that type of event occurring, where something's not required to be disclosed, but the auditor discloses their close call with respect to that as part of the critical audit matter.
Round 4, Mr. Ferguson.
I'm done.
Mr. Harris?
The release refers to the board anticipating the reporting of critical audit matters in the auditor's report to have cost-related implications for auditors and companies, including audit committees. Jay touched upon this, but would you elaborate on some of these cost implications?
Sure. It would have cost implications for the auditors in determining the CAMs, preparing the language to go into the auditor's report for CAMs, and then for documentation. And then, of course, in management and the audit committee, it relates to partly the discussions between the auditor and management regarding the critical audit matters that would be put into the auditor's report, as well as for audit committees having similar discussions with the auditor and management. So we think that the time and effort used by all three parties would increase the cost. We are asking questions about this in the release and asking for feedback on whether or not users and investors think that it will increase costs and what those costs would be.
There are probably some other costs. Those are good examples. We also point out that there'd probably be one-time costs for all audit firms to develop their methodologies that the audit teams would have to follow with respect to the determination of critical audit matters and the documentation. So there's probably one-time training costs, methodology costs around that as well. In addition, the auditor, in addition to determining and documenting, companies may set up procedures to have the critical audit matters reviewed by not only the engagement quality reviewer, but maybe in the early years, some other review by national office or something like that. So again, we are asking for what are the types and nature of costs that could be involved. We're very interested in that. We think the approach was a cost-sensitive approach because the underlying critical audit matters are fundamental aspects of the audit. Having said that, it's a very important disclosure requirement being made here, and we suspect that some costs will be involved with respect to that.
Let me also highlight that some of the costs that we consider are non-direct monetary costs, but cost in other aspects. Let me give you an example. If it were true that a lot of these activities around CAMs were towards the end of the audit, that is time of high opportunity cost. People are already very busy. Those are critical times. People are already having long nights, presumably. There's a lot of judgments that are being made. And that's a non-monetary cost that we are aware of, and we would seek comment from the public to get more flavor upon. Thank you.
Good, thank you.
Mr. Hanson?
A quick clarifying question. The title of the main standard that we're proposing, the auditor's report on an audit of a financial statement when the auditor expresses an unqualified opinion. Could you just clarify if this is only intended to apply to kind of the standard unqualified opinion, or if it would apply to other, the unusual case where the auditor modifies their opinion?
So we are retaining most of AU 508 as it stands, and we are taking out the pieces related to an unqualified opinion and the basic elements. So the basic elements that you normally see in opinion, which are the nature of an audit, what was audited, the scope, we have put that all into the unqualified opinion standard. And then in our, including critical audit matters, in our amendments to 508, we have the auditor looking back to this new standard to determine which elements from the basic elements would be included, and we've outlined which ones those would be. And then for critical audit matters, we are only saying that they would apply to qualified opinions, not adverse and not disclaimed opinions.
And not scope limitation opinions?
Well, that's a qualified opinion, and so then it would be, critical audit matters would be included in those types of opinions.
So the same requirements exist with respect to an auditor's report that includes a qualification of any kind. But it does not include critical audit matters in reports that are adverse or disclaimers.
Okay. Member Franzel?
I have no further questions. Thank you.
Thank you.
Round 5, Member Harris.
In the release regarding the auditor's responsibilities for other information, the additional discussion states that the board's proposal, and this is a quote, one incrementally strengthens the auditor's traditional role with respect to other information, and 2, provides a more definitive basis for describing the auditor's responsibilities in the auditor's report, close quote. If it only incrementally strengthened the auditor's traditional role, would you explain why we're doing it and what exactly is the problem we're trying to solve?
Well, we've changed the language from read and consider, so AU 550, which is a required responsibilities of auditors to read and consider other information in audited documents, will be superseded by this other information standard. So we think that the read and evaluate, we didn't want to say was a monumental change, so we used the term it was an incremental change. But evaluate is a stronger term than consider. It requires deeper thought, and we've included in that specific procedures that the auditor has to perform as part of that evaluation. Whereas AU 550, the existing one, did not include any specific procedures about such read and consider. So we think we have incrementally improved it, and there was a second part to your question, Steve.
Well, no, if it only incrementally improves it, why are we doing it?
Well, a key aspect of changing AU 550 really was, the project really here was about the audit reporting model, to improve the auditor's report. And one of the things we wanted to do was not only include critical audit matters in the audit report, but investors clearly indicated they didn't know necessarily because this was all silent before, they didn't know what auditors were doing with respect to other information or what they found with respect to the other information. And so a key part of this change was to include in the auditor's report the auditor's responsibility to read and evaluate other information, and then for the auditor to reach a conclusion that based upon that evaluation, the auditor has either identified or not identified a material inconsistency, a material misstatement of fact, or both. We think that's a significant change by giving that to investors. That's a very significant change and should give value to investors about that other information. To enhance consistency in that evaluation of the other information, we also improved the other information standard using the word evaluate and having common procedures that the auditor would perform. We think the change overall is a big one because it results in a change to the auditor's report about that other information.
Mr. Hanson.
My last question is just a follow-on to what Steve just asked, and that's the practical implications for what people actually do today versus what the new standard would require. And the release talks a little bit about that. I mentioned, but maybe any one of you, Jessica or Marty or Jen, to talk about your personal experience in the past about what you actually did with respect to like the 10K at the end of the audit when you got a draft of it, and whether what you did in the past would meet the spirit of what we're getting at with the new standard.
So in my experience on the engagements that I worked on, these procedures that we have are requiring in the standard are very similar to what I've done in the past and what my colleagues that worked on with this standard with me have also done. So we believe that a lot of auditors are doing these same procedures, and so we are not asking some auditors to do a lot more than they already are doing. So we think that, this is a kind of a baseline that we want all auditors to achieve, and some may do more, but at least we have a baseline for consistency because we don't know what every auditor is doing.
What I'll say about that, Jessica and I have talked about this, is that Jessica and I both worked on, her experiences and mine, very large audits with what I'll call very sophisticated audit committees. And their expectations, quite frankly, and we've heard this from some of our SAG members at SAG meetings, is that they ask the auditors to evaluate that MD&A and the other information that's in the annual report, and they want the auditors to report back to the audit committee orally that they've gone through that entire 10K and they don't have any concerns about it. So those audit committee members that are the larger corporations and maybe some smaller ones that are very diligent about what auditors do and what they can possibly do are asking for this type of work today. That's not the case we believe across the board. So this will require a high, consistent level of evaluation across the board in all engagements.
Well, unless there are further questions,
I've got a further
Okay.
question.
Go.
And this is my last question, and it's a softball. In the release, you indicate that the recent financial crisis was mentioned as an example of a situation in which expanded auditor reporting in advance of and during the crisis might have been helpful in assessing a company's financial statement and providing early warning signals regarding potential issues. And then the IASB made a similar comment when they released their proposal to enhance the audit report last month on July 25th. They said their exposure draft responds to calls from investors, analysts, and other users of audited financial statements in the wake of the global financial crisis for the auditor to provide more relevant information in the auditor's report based on the audit that was performed. How would you say this standard addresses the concerns of those who raise this issue? And more specifically, what would you say is the linkage, the direct linkage between the financial crisis and the need for this proposed standard, if there is any?
Well, first, I want to make sure that we have a baseline, and that is the auditor's responsibility goes to the financial statements and the audit of the financial statements. And the auditor's responsibility goes to reading other information in the annual report based upon what the auditor knows from the conclusions reached and evidence obtained as part of the audit. As Board Member Ferguson expressed earlier, auditors are not necessarily in a position to evaluate all business risks that a company takes, and a lot of the financial crisis resulted from excessive credit risk and other risks that a business took that were outside the auditor's ability to evaluate how those risks might ultimately wind down or result. What this report does, and I gave an example of it before, though, is the critical audit matters. Hopefully we'll discuss those matters where the auditor is really having a tough time reaching a decision based upon an estimate in the financial statements, and then why they had the difficult time. I did give the example of hypothetically before a 2006 or 7, if the auditor was saying the allowance for loan losses was very difficult to reach our conclusion on because the company introduced new product, new underwriting standards, and didn't have historical experience on determining the loss rate for those types of loans, and the company had to use new models and new inputs to do that, that could have given a signal, that critical audit matter, that investors really had to dig into those type of loans and what was going on at the financial institution, and that allowance for loan losses to get further information from management about that information, or study more detail the risk section of the annual report pertaining to those types of aspects. So we're hoping that discussion of the critical audit matters, saying these are very difficult judgments or difficult in obtaining evidence about these estimates, will provide a signal to investors that they need to learn more about the related financial statement disclosures or business risk disclosures of those matters.
I have the privilege of asking only one question, and that is, will all board members who support and approve of the issuance of the proposal please say aye?
Aye.
Aye.
Any board members opposing? The vote is unanimous. This concludes the agenda. If there's no further business, the meeting is now adjourned. Thank you all.
Thank you, Isaac. Thank you, Jennifer.
I thought it worked pretty well, too. I think we should do it again. Yeah.
I've got to go.